Hello, guys, and welcome to the show this morning. This morning is Friday, November 23rd, 2018. I'm going to tell you what. First thing I noticed this morning just is that bond yields are falling. Massive buying into bonds this morning. They're frightened. They're showing what direction they're going to move. They've been showing for the last little while. At first, I didn't see it, but I see it. Bonds is the safe haven they're going for initially. That's an initial gut reaction is they're going for treasuries. And here's the thing. They're actually, they're probably, I'm going to say, because it's about 7 more minutes until the stock market opens up for me here at the Dow Jones. It was closed on Turkey Day yesterday, and well, listen, I hope you guys had a really good Thanksgiving. Anyway, what's going on here is they're moving money out. I'm going to say that the stock market's going to be down, and fairly significantly. Investors are losing confidence right now because there's so many problems in the world, and they see the United States with a massive debt burden that they can never repay. You'd think that they wouldn't go into treasuries, because treasuries are connected to the debt, to the United States debt. Treasury is only as good as long as America can pay back. And I'm going to tell you, there's only one or two directions that they can actually go with this. They can default on the debt, America can, making the treasuries totally 100% worthless. Or they can print their way out. Print their way out, I mean, they don't actually print nowadays, but they create new money. And that's the way that they're going to have to take, and that's the way they will take. But what they're going to do is they're going to make the money that the treasuries are worthless. So those are the only two directions that they can move in this thing. It's only through a process of elimination we know what's coming. So let's open up the charts and let's take a look and see what's going on right now. We had a precipitous fall in the price of Bitcoin. Bitcoin, you know, the wind has been taken out of its sails. I'll tell you what, I'm heading in there today. I'm going to buy a little bit because I'm cost averaging on the way down. I'm buying a little bit every time and I'm going to average, I'm going to get the average out of what I paid. I'm just buying dib-dabs, you know. I'll probably buy like maybe a 0.2 or something like that, you know. I can't afford very much. But those little dib-dabs, you know, they add up into a chunk of a Bitcoin. And that's what I'm trying to do. But you're not going to need a lot of Bitcoin. I'm going to tell you what, when this thing comes, and Bitcoin becomes a new world reserve currency, which is what I think is going to happen eventually, when the Lightning Network gets completely established. And believe me, it's establishing itself rather quickly. Lack of confidence in the dollar, they're all going to start to swing over to Bitcoin. We've already seen countries like Venezuela and countries like that, they're using the cryptocurrency instead of their own currency in the crisis of a hyperinflation. We're already seeing it start to happen. Cryptocurrency market capitalizations today. What we're looking at is 138 billion. So we're looking at a commodity that the wind is coming out of its sails. The bubble is completely bursting, and there's nothing left of a bubble. Because this market capital, you know, was nearly $750 billion. Now it's $138 billion. Talk about the air coming out of it. It's pretty much getting completely deflated. That's why I'm going to go in and grab a little bit, you know, today. Because I think the air's nearly out of the bubble. There might be a little bit more air to come out of the bubble, but I mean, you got to understand that this bubble's going to reinflate. And the next time it reinflates, it's going to reinflate bigger than it ever inflated before. And so everybody will be getting on the bandwagon the next time, you know. Because it's a little ways down the road. I mean, it might not be... I wish I could tell you exactly when it's going to reinflate. Okay, so now let's take a look at silver today. They tried to smash silver down. And they succeeded in getting it down to about 14.08, something like that. And it bounced back. It bounced back up to 14.25, but it's still down 21 cents on the day. And so that's quite a hefty smash. We're going to have to see if it can rebound and catch back up to the 14.50 range. Silver is fighting for survival right now. And one of the reasons why is deflation. That's not one of the reasons why, that's the big reason why, more so than price manipulation at this point, is deflation. Because if we look and we see the oil price going down, I'm going to tell you what, that's the deflation, and the same thing's affecting the price of silver, gold, all commodities. I haven't checked the price of copper, but copper would be a good indicator of how these commodity prices are taking a beating because of deflation. Well, this is also going to make the dollar stronger right now, but this is a very temporary thing. It can be all changed at the motion of a pen. It can with the Federal Reserve, if they come out and they announce that they're done with quantitative tightening, that they're going to have a new round of quantitative easing, and if they also show more areas of monetary support throughout the system, this would all turn around. They could turn it around tomorrow morning. They have the power to turn it around, and they've already told us that they're data dependent. So if the stock market takes a big tumble, they could turn right around. The Fed could come right out and announce what they're going to do and change monetary policy overnight. Maybe before we even get a total crisis. They could avert a total crisis, and they have that power to turn everything around. And we might not, I mean, if the Fed was really dovish, we might not even get a full deflationary event. Like the deflationary event might be just the precursor or prelude to the deflationary event. And if the Fed turned around at that point and became uber dovish and went back to easy, loose monetary policy, honest to God, it could all be averted, and we could go right into the hyperinflation, boys, because we're ready, you know. There's enough dollars out there already printed. So now let's take a look and see what stocks are doing this morning. Crude oil. Crude oil is a big story, you know. Take a look at what's happening in crude oil. It's down $3.38 on the day, 6.19%. Honest to God, look at this thing. It's falling off a cliff. This is going to send shivers through the financial system if we didn't have enough problems already. They think the financial system is rock solid. Oh my gosh, the financial system's ready to collapse. And they think it's rock solid. They think, oh, we got a great economy, you know, just because of the fake job numbers. That don't mean diddly squat. What we've been doing is we've been basically going along with a level, flat economy ever since 2008. It hasn't really went up that much, and it hasn't really went down that much. But now that they're sucking money out of it, I mean, they're sucking money out from underneath it. So it's not noticeable at first, you know. It's suspended because this money's been sucked out from underneath, and that's what the Fed's been doing. They've been sucking money out every month. Let's take a look here at the Dow Jones and see if she's open yet. Yeah, she's down 173 points on the day so far. I knew she was going to be down. I was thinking it was going to be even more because I seen the bond sell-off. When you see that bond sell-off, you know money's moving out. Money's moving out of equities and moving into the bond market, into treasuries. And so we see that money movement, and let's take a look at bonds, and you can just see it here. You can see the movement of the money. Let's take a closer look. The U.S. 10-year is the one I watch the most, and it's down to 3.034%. So it's dropped from like 3.6 something, 3.65 I think it was last night. It's dropped down to 3.034%, so it's dropped like 3 basis points on the U.S. 10-year. I'm going to tell you, these bond prices are going to go back up again. But I'm going to tell you what, there's been some tremendous bond buying here. And these people that are buying these bonds are going to get burnt. They're going to get burned because as these interest rates rise, these bonds, they're very sensitive to rises in interest rates. When you buy a U.S. Treasury, say you buy a 10-year U.S. Treasury, that interest you're going to make, if it rises on the new bonds, it makes your old bonds that you have that you bought at a lower yield worth an awful lot less. It really chops them bad. Every point chops them really bad. And the thing is if you start to move 3-4 points, I mean, you're chopping into the value of that bond hugely. So the people that think that you can't lose money on bonds, you better think again. If the bond yields change value rather rapidly and the yield goes up and you bought a bond in at a lower yield, I'm going to tell you, it chops into that bond something awful, and you can lose a lot of money. A lot of money. So for these big investors out there who are buying into these bonds thinking that bonds are something you can't lose, maybe they haven't done their homework, but you can lose a lot of money buying bonds. And these bonds, in a crashing bond market, and these bond yields are going to crash. I mean, these bond yields are going to go up, and the bond market's going to crash. And the thing is these guys, they're thinking that bought in at nearly 3.25 on the U.S. 10-year or a higher yield on the U.S. 30-year, they're thinking right now, hey, you know, we got a good bargain on these. Oh, wow, look at the bargain we got, because now the yields have fell back down again. And we got in at a higher yield, and they're patting each other on the back right now as if they got success. Well, they don't see what's coming. You're going to see these yields shoot up. And I'm not talking on the U.S. 10-year just 3% like it is now. This sucker's going to 6 or 7%. That's what's going to happen. And in the not-too-distant future either. So these guys are going to get burned. I can just see it coming. Let's take a look now at the dollar index. And I knew this would be going up. This is going to go up until this episode, until the Fed relents, until they go back to easy monetary policy. As long as they continue to tighten, this dollar is going to continue to go higher, and this is deflationary. We're in a little bit of it's just beginning. This deflationary event is going to lead to the hyperinflation, and that's where we're going with this. The dollar index is going to go up, and it's 96.83. This is going to be hard on gold and silver. As the dollar goes up, it puts pressure on gold and silver to go down. But also, you got to understand that oil price moving the way it is got a total effect on the U.S. dollar. The U.S. dollar is going to have a lot of pressure on it to go up right now. And this is going to put tremendous pressure on China. Because China China's debt problem that they have right now, and the dollar going up, China is actually caught in the category of these emerging markets, having to pay back money that's harder to pay back and at a higher rate of interest. And the money's not really there. I mean, they're over-leveraged. They've borrowed too much. And they're in this situation where the Chinese economy is right now, as we speak, starting to unravel. It's the second biggest economy on Earth, but not, I mean, the second largest economy on Earth, but not by much. I mean, it's not far off of the United States. Like the two economies are close in size. It's not that much smaller than the United States economy. And so it's a really large economy. And let's put it this way, it's easily a big enough economy to bring the entire world system down. Economic system down, and they've got huge problems within the shadow banking sector in China, and oh man, I mean the real estate sector. Oh my gosh, it's just such huge bubbles. It would dwarf the 2008 real estate subprime crisis that happened. Subprime crisis that happened in the United States. The Chinese real estate bubble is so big, it would dwarf the crisis that happened in 2008. In fact, if the real estate bubble in China fully bursts, it's going to create a deflationary event that I don't know for sure if the Fed could actually even control it. because the amount of money that would have to be created in order to pull the world's economy up from that, if the Chinese real estate bubble fully burst, would be, it's just unfathomable. It could carry the world down into a deflationary funk that they couldn't pull it out of with any amount of money creation, practically. Well, they'd have to go so far with the money creation that they would swing everything into a massive worldwide hyperinflation. I mean, a situation like that, I mean, let's just hope that the Chinese real estate market bubble never bursts. It just has to keep getting bigger and bigger and bigger. Listen, thank you guys for listening. Like and subscribe, and we'll catch you in the next show. Bye-bye, guys.